Doctors, good afternoon. Great to see everybody. As always, hope you and your families are well. Thank you for joining the Doctors Council Free Tax Prep Forum for Doctors, presented with our colleagues, Stacy Braun. We are recording tonight's presentation, and also we'll be able to share the PowerPoint once we finish up with the presentation. But again, wonderful to see so many of you, and hope you and your colleagues and your families are well. Let me bounce it over to our president, Dr. Frank Proscia.
Thank you very much, Kevin. Hello, doctors. Great to see everyone tonight. I hope 22 is off to a better start than 21 had. I wish you and your families and colleagues a happy and healthy new year. I know we're all busy, especially with this ever-evolving pandemic. I wish this crisis would go away, but that doesn't seem to be happening. I'm so proud by what you and your colleagues do every day for our patients, their communities, and for that matter, for each other. We will get through this together. Another thing that's not going away are taxes, as Kevin mentioned. That's why we're having tonight's tax prep forum for doctors. Your time is valuable, and we want to provide you access to the Doctors Council benefit for our members and families, our tax preparation services and financial planning through a partnership with Stacy Braun Associates at greatly reduced rates. Doctors Council provides many services to our members, including bargaining, job protections, grievances, and arbitrations to protect your contract rights, compensation, giving you a voice at work, and including such forums. I want to thank you again for your participation, and now back to Kevin.
Thank you, Dr. Proscia. We appreciate your comments. Tonight's presentation, what we're going to do is here, and we're very pleased to have Paul Kiley from Stacy Braun with us. Paul Kiley from Stacy Braun with us, who's a Master's of Taxation, a certified financial planner, and IRS enrolled agent. We're going to go through the presentation. Then some of you were good enough to submit questions in advance, which I will bounce off of Paul. And then any other questions that come up after that, if you can send it to me in the chat function, that'd be great. We'll, time permitting, get through those as well. And if we don't get to any of them, if you have some afterwards, I'm sure Paul will work with us to get back to you in short order over the next foreseeable future. So with that being said, and again, we greatly appreciate Paul being here from Stacy Braun. Let me make Paul a co-host.
24 years, we've went from the institutional management end primarily to more of a financial counseling, tax advising for individuals, and actually individuals within unions. A little bit about myself. I have a master's degree in taxation. I'm a certified financial planner, as well as I'm an IRS enrolled agent, which means I'm licensed by the IRS to prepare returns and represent clients. The next slide, history of the US income tax, is a slide that I like to show. We could go to the next slide, Kevin.
Just 1 second, Paul. It appears to have frozen again.
All right. So the slide we're talking about here is the history of the U.S. income tax code. You know, like I said, taxes aren't going away, but over the course of time, our tax code has fluctuated greatly. And, you know, we're still seeing major changes that took place, you know, 4 years ago, which we'll go into in this presentation. We saw some minor changes that took place during COVID, might be minor, might be actually large changes to some of us. And then, you know, there was a lot of chatter and talk about tax changes taking place more recently with the Build Better bill, which looks like it may have stalled in the Senate at this point. But the history of the US tax code basically started back in 1863 to fund the Civil War. After that was paid for, they rescinded it. ratified again back in 1913. Gave power to Congress that levy taxes on income. Now, when we talk about tax brackets, if we look here, this chart's kind of interesting because it kind of shows us what the top marginal rates were during each year or, decade. So if you look, it started out at roughly 8-10%. Back in 1940, 1950, the top tax rate was over 90%. And today we're in that, high 30-40% range. So it's just an interesting chart to kind of see historically where our top income tax brackets have been. So just a good reference point. Now, on the next slide, we're basically now here looking at the basics of how our taxes are calculated. And we're going to go through these steps, which I think are helpful because kind of gives us all a little better idea of exactly, what people say. You hear terms above the line, below the line deductions, adjusted gross income. And we're going to go through how step by step our taxes are calculated. So we're going to say step one, income minus adjustments, okay, give us our adjusted gross income. That's what we call above the line deductions. And we're going to go into that. Step two is your adjusted gross income minus your itemized or standard deductions, which then give us our taxable income. Simple enough there. We take our taxable income and we times it by our tax rate, okay? And that gives us how much tax we owe. But we're not done at that point, okay? We then have to take credits, okay? And credits are different because credits are actually dollar for dollar reduction in our tax liability. We take any credits, tax credits we may have, we reduce that off our tax liability, and that's what we owe in taxes, okay? There's a hard number there. Then what we need to look at is how much did we pay or withhold throughout the course of the year, and whether that will decide whether we get a refund or if we owe, okay? And we're going to step into these different steps now. So now on the next slide, step one, we're looking at our first piece, which is income less adjustments. And this is where people hear terms, but the term above the line deductions. So what is the income? What's income? Basically anything you can imagine is income. If you bartered for outside the normal, commissions, W-2s, fees, co-pays, insurance insurance companies paying you on a 1099 if you're a private sector, have your own practice. But fees include everything, okay? Like I said, if anything you do, wages, self-employment, business income, investment income, capital gains and losses, pension, social securities, IRAs, gambling winnings, unemployment compensation, all are sources of income, okay? Basically, everything is considered income, okay? Then we have adjustments, okay? And the adjustments that we're looking at here are things like IRA contributions, okay? 403B, 401K, 457 withdrawals, okay? We're looking at new for this year, which is important to know. And when I mean this year, I'm talking 2021 for your tax returns, is if you do not itemize, and we'll go into what itemizing is in the next two steps. But if you do not itemize your return, okay, you can still take charitable deductions up to $300 if you're single and $600 if you're married filing jointly, okay? Last year, it was $300 for either single or married filing jointly. This year, it's $300 for single and $600 for married filing jointly, which would come off your income, okay? As long as you're not an itemizer, someone who itemizes their return. Student loan interest is deductible, certain to some income limitations. So depending on where you are in your career, some of those loans could or could not be deductible based upon your income. Alimony paid for pre-2019 settlements, okay? meaning if your divorce was settled prior to 19, your alimony paid to your former spouse would be deductible. Educator expenses, okay, self-employment tax deduction, self-employment health insurance tax deduction. Big ones here, I think, for most of us are potentially, the student loans, if there is alimony, but the real big ones are the 401ks, the 403bs, the 457s, and the IRAs. Those are the real big deductions, what we call above the line. So if we take our gross income and we minus out these adjustments, we come up with a term that we're all kind of familiar with, adjusted gross income, or AGI. Now, the next slide, which is a copy of the 2021 1040. I put it on here, not many major changes to this form. Most of the time when you see this form, it's already populated because you've used some type of software to complete your tax return. But major differences, nothing major from the previous year, but one of the things they are asking, and they did last year as well, was that if anyone, they're basically asking for virtual currency. So if you look right under the first gray section, at any time in 2021, did you receive, exchange, sell, or otherwise dispose of any virtual currency? So they're looking at the Bitcoin type transactions. So, and the next slide is essentially, kind of going through the calculation and then actually where you would technically, sign the return on the bottom, or your preparer would put their information as well. So step one, really what we're looking at is what's the gross income, okay? And then we're looking at taking those deductions out to come to what's called the adjusted gross income. Now, on the next slide, step two, okay, what we're looking at is the term AGI, and I'll just repeat it, adjusted gross income, less a standard deduction or your itemized deduction, okay? And you don't have a choice in what you take. It would either be whichever is higher becomes the deduction that you would then take, okay? So on the next slide, okay, we'll look and see what dictates whether we take a standard or an itemized deduction, okay? A standard deduction, and these are the new figures for 2021, okay, based off of 2020. Last year, if you were single, you received a standard deduction of $12,400. This year, it's $12,550. Married filing jointly, it would be $24,800. This year, $25,100. If you're going to itemize, so what the federal government is saying, and if we go back, because we go back 4 years, the standard deductions were half of what they are today, or less than half of what they are today. And back in 2018, federal government came in and said, you know what, we got to try and simplify our tax code. And it's too cumbersome to audit, too cumbersome to maintain all these itemized deductions. So we're going to increase the standard deduction, and more people will fall into this automatic write-off, okay? But if we look at what we could itemize, okay, we would need to have medical expenses over 7.5% of our adjusted gross income. So let's say our gross income was 110,000, and we put 10,000 into a retirement plan, and our adjusted gross income then would be, 100,000. In order to take a write-off for medical expenses, it would have to be over $7,500 in that calendar year for medical. So to get a write-off for medical expenses, you really need to be spending over 7.5% of your adjusted gross income on medical. It's a hard hurdle to reach sometimes if we have health insurance and strong health coverage. This is the one that was the big change that took place as well, especially for people like ourselves that live in the higher tax New York, New Jersey, Connecticut areas, and also as well as California and Illinois. is state and local income taxes and property taxes are limited to $10,000. So any income taxes you pay, okay, as a household to the city of New York, the state of New York, or Connecticut or New Jersey, and your property taxes are all capped at $10,000. So you may pay $20,000 in those taxes, but you only get $10,000. And that's what the term SALT stands for, state and local income taxes. Another change that may or may not impact many of us is primary and secondary mortgage interest is deductible up to $1,750,000 after 2017. So if you refinanced your mortgages and you had $900,000 worth of mortgage and you just did a straight refi, it's still deductible. If you took a new mortgage out or went over the 750, then it would not be deductible. Okay, the interest on that mortgage. Charities, if you could get above the number, and casualty and theft losses. Okay, but it must be in a federal disaster area. Okay, so what really happens here is either you say, I have medical expenses over 7.5% of my income, and how much over that? Okay, that's where you get the write-off. So if you have $8,000 of expenses and $100,000 adjusted gross income, you only have $500 of an itemized deduction. Okay, then you go to your state and local income taxes and they're capped at 10. So you might be at $10,500. Okay, if that's what you have in the way of taxes and you're single, instead of taking a $10,000 deduction, you're going to take the $12,550 because the standard deduction is higher than what you're capable of itemizing. So what we do at this point is we take our adjusted gross income and we minus the deductions. And what that does is it brings us to our taxable income. Now, the next slide, which is what we call Schedule A, you see that on the top left. This is where you would calculate, okay, or this is the form that would calculate your itemized deductions, okay? This is the form that asks you about your mortgage interest. It asks you about your state and local income taxes. If you look on the side, your medical and dental expenses, your gifts to charities, your casualty and theft losses, as you look down the left-hand column. And this is where you would use this chart, okay, or this page and the instructions for it to kind of gauge whether or not you would be taking an itemized or a standard. Now, if you look at last year's tax return and you don't see a Schedule A, chances are, okay, it could be missing. I doubt it, but it could be. Or there was no need for the Schedule A because you took a standard deduction. Now, on the next slide, we're going to see miscellaneous itemized deductions. This was one of the big changes. And I know it's, you know, taxes are one of the areas where, you know, are, how to put it, taxes is one of the areas that are current, how we're used to doing our taxes is hard to change, okay, because it's embedded in us. I hear people all the time asking about tax codes that were in place 20 plus years ago and how they've changed radically till today. But once again, that's how they did business. For instance, the last time they sold a house 30 years ago, the tax code was much different than it is today. So that's why it's, you know, it's good to kind of look at this again, even though many of you might be like, well, that's 3, 4, 5 years old. Okay. 2017, miscellaneous itemized deductions were removed from the tax code. Okay. So the standard deductions doubled and the government said, look, we're done. We're done. We don't want to track all of these, we'll call them nickel and dime expenses. So things like union dues, they came out and said, no more, it's part of the standard deduction. Difference here though, and very important, is it's still New York fully deductible. Unreimbursed job related expenses. This is a touchy one, okay? because a lot of you may pay for licensing, continuing education, etc. If you are a W-2 employee, meaning an employee of an institution, you could no longer deduct those expenses. Work-related travel can't be deducted, malpractice insurance, professional licensing, educational costs, investment advisory fees, income tax prep fees, safe deposit fees. All of these were eliminated in 2018, okay? Keep in mind though, this only relates to W-2 employees. It's still deductible on Schedule C and business returns if you have a private sector business, which I know some of you do, but some of you may not as well. And the other thing to consider here was miscellaneous itemized deductions kind of were not as impactful if you were subject to something called the alternative minimum tax, which we haven't seen once again since 2018. But a lot of times clients would come in, provide all these fees, we would look at them and then turn around and say they're worthless because you're subject to the alternative minimum tax. And then maybe deductible for New York returns with some limitations. So just, kind of important to take a look and say, I still have people hand me their safe deposit box fees. They tell me how much their tax fees are. They're giving me their malpractice insurance. Once again, if it's on a regular 1040, you're a W-2 employee, non-deductible. Now, the next chart we're looking at here is step 3, which is we have to now take that taxable income and throw it into the chart, okay, and say, okay, what's our tax rate, okay? And this chart just gives us an idea, okay? And the one thing I like to point out is, because I get the question all the time, is I'm going to quit my secondary occupation or job because I don't want to go into the next tax bracket, okay? These are what are known as marginal tax rates, okay? And what's really important are your effective tax rates, okay? So I had an individual who, we'll use an example on this chart, came to me and said, my spouse and I are at $173,000 per year. And I said, okay. And they said, I think I'm going to cut my overtime. My spouse and I would be earning $173,000. I think I'm going to cut my overtime so I stay below $172,750. And I said that's not necessary. Okay, you don't need to cut your income. And they were under the impression that if they went $1 over the $172,750, okay, as you see in the left-hand column under married joint return, that all of their income would then be taxed at 32% as opposed to 24%. Now, the truth of the matter is if they went $200 over, that $200 would be taxed at 32% instead of 24%. So 8% on $200, $16 more in taxes would be due that given year. So it's important to understand that your taxes, your effective tax rate is what is important. And it's the blended rate. And that's what the effective is. It's the first 19,900 at 10%. The next X is at, 12 to 22 to 24 to 32. It's a graduated tax scale. So just important to understand that if you do go into the next bracket, in most instances, it's only affecting the few dollars that you're going over. Now, on the next slide, if we look at step 4, okay, once we do that calculation and once we have that in place, we know what our taxes are, okay? So, we made 100,000, our effective tax rate is, I'm using a round figure, 15%. I owe $15,000 to the federal government, okay? But then you have to turn around and say, okay, but I may have tax credits. So the big ones, there's a few out there, okay? But these are the big ones. Child tax credit, $3,000 per child under the age of 17. If they turn 17 in that given year, you do not receive that credit. This year, which is new, it went to $3,600 per child, ages 5 and under. So I just put under the age of 6. Okay. If your income is over 200,000 single or 400,000 married filing jointly, it begins to phase out. I think if you're married filing jointly, it completely phases out at around 438. Child independent care credit, okay, for children under 13. For 2021, okay, it's 35 to 50% of a credit up to 8,000 for one child and 16,000 for 2+ children, or anything more than one child. This is up from last year, which I think was 3,000 to 6,000. So significantly more here if you have childcare expenses. And once again, subject to income phases 200, 400. Then if the kids are older and we're out of the daycare and tax credit zone, we could be looking at the American Opportunity Credit. And this is the college credit for first 4 years of undergraduate. And this is 100% of the first 2,000 and then 25% of the next 2,000. So as we all know what college tuition costs these days, hard to get an education for under $4,000. So we're probably looking at around a $2,500 credit for like I said, the first 4 years of undergrad. Phase out here though could be an issue as well. As you could see, the federal government is looking to limit the amount of credit they provide by kind of putting income caps on it. So you're phasing out at 80,000 single and 160,000 married filing, married filing jointly. And then other credits that are out there, lifetime learning, savers credit, earned income tax credit. You could be getting solar credits, electric EV car credits. There's a lot out there. These are just some of the bigger ones. And if we understand how credits work, we understand how valuable they are. So in this situation, if this family, for instance, had 2 children, 12 and 13, their $15,000 tax liability, could be reduced to $9,000 because they get $3,000 per child. A pretty significant reduction. So important to understand the value of credits and deductions, and those above the line as well. So on the next slide, we're looking at figuring out the amount owed or refunded. Okay, so basically it's that tax liability we're looking at. We're looking at, okay, I owed 15, I got 2 kids, went down to 9,000, and I had $10,000 withheld from my check in federal income taxes. So I only owe 9, they withheld 10. I get back $1,000. Okay, so I'm due a refund. Okay, so this is another misunderstood step. Okay, people tell me they owe too much in taxes. Well, owing too much in taxes is another way of saying you under withheld throughout the course of the year, meaning you didn't take enough from your payroll. And what occurred, you under withheld, which means you pay at the end. People who say they always got a ton of money back, okay? What that really means is you're not getting or giving more or less. Your tax liability will be what it will be. And your determination on whether you get a refund or owe is based upon how much was withheld over the course of the year. And that's the biggest thing. So constantly, if someone is continually owing taxes each year, I will tell them to change their W-4 statement and maybe add an additional, for instance, if you constantly owe an extra $4,000, $5,000 a year, just have an additional $200 federal withheld per paycheck. If you're constantly getting back and you don't want to receive a refund, you'd rather the cash flow throughout the course of the year, then you could under withhold, or you could change your withholdings to receive more. So once again, it's not that the government's giving or you back more or less. It's basically what you're withholding or what you're paying throughout the course of the year. Now, on the next slide, if we look at employment status, okay, if you're an employee, your income is reported on the W-2, okay, meaning that you're an employee. The W-2 income is the income where you can't take those, remember we discussed those miscellaneous itemized deductions. It used to be the safe deposit boxes, the tax fees, you know, the continuing education credits or licensing fees that maybe the city or state's not picking up for you. If you're an employee, you get a W-2, okay? A C Corp, okay, is a separate return, okay? It's a corp, and you're taxed at corporate tax rates with a C Corp. Pass-through entities, okay, which are like sole proprietors, partnerships, LLCs, S Corps, are when income flows through to your personal tax return, and it's taxed at your individual rate, okay? So if you have any of these types of business structures, you know, you're filing a return, potentially a Schedule C on your 1040, or you're filing a return at the partnership level, and then it's passing through and goes on to your 1040, and you're taxed at your rates. If you're a C Corp, you're taxed at corporate rates. Now, the next slide, you know, it's a lot of information on here. And, you know, it kind of gives us just a view of, you know, some of the changes that occurred. For instance, from 2017 to now. So if you look at as an employee or W-2 column number 1, you'll see that you get a W-2, yes, okay. You know, in taxes are, you know, as an individual, they flow through to your return. And it's from a liability point, you know, protection is high because you're an employee, the employer is responsible for the most part. Prior to 2017 or 2017, you could take those deductions that we talked about, those itemized deductions, or those, I'm sorry, miscellaneous itemized deductions, if they were over 2%. Now in 2021, you can't, okay? And if you look across the columns, you know, you'll see exactly the, you know, how you're filing, included on the 1040, whether you're filing a Schedule C, a Schedule E, whether you're filing on income taxes as an individual or on the last column as a corporation. You know, you'll see on your business expenses, one of the bigger areas are, if you're an employee, your business expenses are most likely not deductible or aren't deductible. And if you're any of the other entities, they're fully deductible. So just, you know, and then also New York City has a corporate tax or UBT tax as well. So this chart's kind of, you know, not meant to replace your due diligence and looking if you're setting up a corporation or firm, but it's just to kind of give you an overview of some of the forms and some of the differences that you're looking at. Now, on the next slide, it gets interesting because in 2018, the corporate tax rate dropped to 21%. In the past, though, income from entities such as proprietorships, LLCs, partnerships, and S Corps passed through to the taxpayer and taxed at the individual rate. But some of the individual rates a lot of the individual rates are higher than the corporate tax rate. So with the new tax law, you know, individual rates might be higher than the corporate tax rates, which I would say they probably are in most cases. They wanted to give pass-through entities a deduction. So what happened is they passed a business deduction of 20% if certain requirements are met, okay? And a pass-through, once again, is where the income is earned in like a business, an LLC, a partnership, but the partnership, the LLC, the S Corp doesn't pay taxes. It just says, we made $50,000 this year. You're the sole owner or partner. We put the $50,000 on your tax return. Okay, in that case, they would say you're taxed at your ordinary income tax rates with that. And in this case, 20% of it would not be taxable. Okay, they would drop it to 40,000. So it's just trying to equalize the pass-through entities, like the proprietors, the LLCs, the partnerships, and the S corps, is trying to equalize them with that lower corporate rate of 21%. Now, on the next slide, if we look at deductible expenses, okay, now, once again, keep in mind, these are if you have an outside practice. Any expenses related to your non-W-2 practice. So all of you get a W-2. It's just any outside private businesses that may be held. You can deduct your insurance costs. You could deduct your continuing education, your certifications, your licenses, your accounting, your supplies, your rental, your travel, your meals, your phone, your computer, your internet. All of this would be if you are an outside and you were not a W-2 employee, okay? You would have to have your own business in order to do this. On the next slide, okay, we're going to take a look at now.
Paul, you need to unmute, if you'd be kind enough.
Oh, sorry about that. I don't know where.
So
Okay.
we're up to this slide, investing to reduce and defer taxes.
Okay, so if we're looking at best ways to, because a lot of people ask, hey, what's the best way to reduce my taxes? What's the best way to like defer taxes? That's our game plan here. We want to work within the tax code to, do things, as best as possible. So investing to reduce and defer taxes, probably the best way to look, and one of the best is, the 457, the 401k, the 403b, and we'll get to that on the next slide what those are. Those are the tax codes used for you to take money from payroll and invest it into through your company or business to invest it into a retirement plan. Okay, and those usually offset dollar for dollar. So if you make 100,000 and you put 10,000 into your 403b or 457, you reduced your income to 90,000. Roth IRA. Roth IRA is excellent. It's something that needs to be evaluated, though, because we have to look at current tax liabilities, potential future tax liabilities, and then we need to take a look at also income limitations, because there are income limitations on the Roth. SEP IRAs, if you're self-employed IRA, basically up to 25% of income. Municipal bonds, delays the taxation or gives you tax-free, tax-reduced benefits on the growth. Exchange-traded funds, these are what are called ETFs. They're tax-efficient investments, less turnover in them. You're still going to get dividends out of them, potentially, capital gains, etc., but they're sometimes more tax advantaged. And then you have life insurance and annuities. Life insurance and annuities are sometimes used as, tax deferred vehicles or tax deferred vehicles, or tax free in some instances with life insurance. If you were to pass with it, the benefit is non-taxable. But the growth in here could either be, pretty much deferred. So these are just some of the vehicles. I mean, there's no one fits all on this. It really depends on what your current tax rates are, what your potential future tax rates are. It depends upon as well, maybe where you're planning to retire long-term, whether the state taxes there are higher or lower than what you're currently paying. So on the next slide, we're taking a look at the IRS tax codes. And these sometimes get confusing, but they're all pretty much identical. And I like to just say that the main differences between these, if we look at, say, the 401k, the 401ks are for-profit companies. For instance, General Electric, Apple, Stacy Braun, our company, okay, Microsoft, Tesla, all of them. They're for-profit corporations. They have a tax code called the 401k. A 403b is for nonprofits and schools, hospitals, and charities, okay? So a lot of you working at a hospital may see or have a 403B, okay? So 403Bs are representing that sector of our employment, okay? The nonprofit schools, hospitals, and charities. A 457B is for government employees. So if you work for the city, townships, counties, states, etc., you have the option of doing a 457 plan. Now, some of these will overlap, okay? So if you happen to work at a hospital for the city, you may have the option of doing a 403B or a 457, okay? And or a 457. So it's important to know that you may get overlap and what the limits are on that. Now, on the next slide, okay, we'll go in a little bit about the limits. So like I said before, probably the single best way to reduce your taxes is to contribute to a retirement plan, okay? And what that does is it reduces your taxable income by the amount you contribute, okay, which could essentially lower your tax bracket and lower your effective tax rate. The 2022 contribution limit is $20,500 if you're under the age of 50. If you turn the age of 50 in that calendar year, you could go up to $27,000 per year in the respective account. Pre-tax contributions, you get the money goes in prior to being taxed. So a big one would be if someone said, well, if I put $1,000 into my 457 plan per month, I will lose $1,000 of take-home income. And the answer to that's no, it's not. If you can afford, okay, to reduce your income by $1,000 per month, you could probably put $1,300, $1,400 into your 457 because it's pre-tax. So your take-home will be significantly, won't be as impacted as much as you're putting away. So in an example, a $1,000 contribution per month would mean you're probably coming home with $700 less per month, okay? So $350 a paycheck less, but you're putting $500 a paycheck into your retirement plan. Now, the key here too is that the money grows tax deferred, okay? So it's not taxed on the way in, it grows tax deferred, and growing tax deferred, it becomes taxable on the way out, okay? So when it's withdrawn, and hopefully, or maybe we're in a lower tax bracket, maybe we're in a lower tax area, okay? Maybe we've retired to Florida, Tennessee, or to states that have very low income taxes. The tax deferred growth, while in these higher cost and higher tax states, might be beneficial for compounding and growing, and then you may actually pull it in a lower tax state. So something to consider. Now, the limitations are interesting. The limitations for 401k and 403bs are combined. So if you have access to a 401k and a 403b, the most you could put away is the $20,500 and over 50, $27,000. But the interesting thing is the 457B has its own limits. And you could do both a 457B at, let's just say you're over 50 at 27,000, okay? And you could do your 403B at 27,000, meaning you could put away up to $54,000 that year, okay? Because the 457 limit is separate than the 401k and 403b. So it's not uncommon to see someone who works in a hospital for the city or a school district, okay, which is a public district with a 403b and a 457, and those individuals have the ability to contribute to both, okay, and max out if they're over the age of 50 at 54,000 or under at 42,000. So just something to look at and understand if you're in that position. The next slide we'll go to is the Roth IRA. The Roth is funded with post-tax money. Okay, this is money that you've already paid taxes on. So you take your paycheck, it goes into your bank account, and then you put that money into the Roth account. This money grows tax-free, okay? It deferred or free. So the money's growing tax deferred, and then withdrawals are tax-free if you take them in retirement, okay, or meet the structure of the Roth. But the problem with the Roth IRA, and I see it all the time, is you may get out of college or medical school in this case, and you might be earning less than what you're as you're going through your residency, you might be earning less and subject or able to contribute to a Roth IRA. But the Roth IRA has income limitations. So in 2021, okay, if you're single, you're capped out at 140. You can't contribute to a Roth IRA. And if you're married, you're capped out at 208,000. So if your adjusted gross income is over 208,000, meaning if you and your spouse, for instance, earn 280,000, you can't do a Roth. Okay. There's something called the backdoor Roth, and that's when you make a contribution to an IRA and then convert. Okay. This was just kind of in the most recent legislation. It's a loophole. I'm imagining they're going to try and close it. They did in the last bill, which got stopped in the Senate. But it's still available now, and I'm assuming maybe for 2022 as well. So just to understand the differences, the Roth, I always use the term pay now or pay later. On a traditional account, you pay later. Okay, you don't pay taxes on the way in. It grows tax deferred. You pay on the way out. On a Roth IRA, you pay now. You pay your taxes now. It grows tax deferred and it's tax free when withdrawn. You might start seeing Roth 401ks, same concept, but the 401k takes the income limitations off. So I've seen Roth 457s, I've seen Roth 401ks, and it takes the income limitation off, and it has to be done through payroll. So it's essentially your retirement plan, but in Roth mode as opposed to traditional IRA, meaning taxes paid today and not tomorrow. So on the next slide, how did the healthcare or the TCJA affect healthcare professionals? And it really depends. Okay, it depends if you're a W-2 employee and do you have a private practice. Like we discussed before, for the W-2 employees, it's the inability to deduct those miscellaneous itemized expenses. It's that, hey, I did continuing education. I traveled to and from this seminar. They're not reimbursing me. Do I get to write it off? And unfortunately, it's no, or they're not paying for my licensing renewal. As a W-2, you can't write it off. And that was a big change. Like I said before, too, some of the change you saw might not have been as great because you might have provided your accountant all your tax information, but to be honest, you may have been subject to this alternative minimum tax term. We don't hear much more because it's pretty much non-existent at this point. It's still there, but very few people are impacted. So a lot of people got very upset, but in the long run, it was, hey, it didn't really make much of a difference that I lost those miscellaneous itemized deductions. But, if you have the LLC, the S Corp, the C Corp, there's no reduction in the expenses if it's related to the entity. Okay, so, if you have those licensing fees, those educational fees, you have those fees associated with the seminars and to and from, and if you have those other business entities, you can still take the write-offs. So just important to know that. Now, there was also the CARES Act on the next slide. CARES Act changes. And some of this stuff is from more last year, but may pertain to this year. Stimulus checks, if received, are non-taxable. There was the PPP program, and a lot of that stuff was forgiven if it was filed. I'm not going to get into that here because if you own a business and you filed, that's something that you would need to, go through. Deductions for charity was raised. The standard deduction issue here, if you're taking the standard deduction, you can do that 300 single or 600 married filing jointly above the line, meaning that you can take it where normally the charitable deductions, if you took a standard deduction, have no value. Okay, it's all part of that number they gave us. They said, here, you could take up to $12,550 and your charity's in there and everything's in there. But due to COVID, they're saying that you can take, if you itemize, you can still take 300 singles, 600 married filing jointly. You know, in 2020, there were no RMDs. It was suspended. For 2021, there were RMDs. And for 2022, my assumption is there will be required minimum distributions as well. The retirement plan loans don't exist anymore. You can't take them, but you did have time to return the money into those plans. The term was, I think, a 3-year, where you could put the money back and not have to be concerned, or you would then be able to not feel the tax implications on it. It's kind of a way to squeeze the money back into the account without the tax implications. Now, on the next slide, we're taking a look at the IRS audit. You know, and people say they're audited, and it's just important to understand, you know, a letter audit is very common, okay? And it's the IRS is just requesting information on a discrepancy that needs to be explained, okay? So they might send you a letter saying like, hey, there's a discrepancy here, okay? And then you would just basically respond with the information, okay? You know, so very, very not intrusive. They're just questioning one item. It could be something that didn't match up correctly. It could be a deduction you took, a form missing. It could be anything that their computer program basically just flagged. An office audit, the IRA calls you into the office, has questions regarding the return that can't be handled via a letter, and it's usually limited to one particular item. Okay, so they're basically calling you in and saying, look, too complex to do through the mail and just a simple issue here. So why don't you come in, let's take a look at it and figure it out, okay? A field audit is more severe. It's when the IRS comes to your office, you know, to examine records, and it's all inclusive. So, you know, they're looking for everything and anything, you know, and then, you know, you're talking a random audit. They're not looking for anything in particular. So, you know, the chances of being audited are less than 1%, but the more you earn, the more chance you have of actually being audited. So when you get the letter in the mail, it's really not a need to panic. It could be that they're missing a form, they want clarification, and you provide it, okay? And I say a majority of the audits that you see are going to be letter audits, you know, asking for clarification or further documentation. Now, on the next slide, we could take a look at some just additional, you know, tax considerations, things that are, you know, a little quirky. You know, like 529 plans used to be qualified higher education. Now New York State says you could use it for K to 12. But I'm sorry, the feds say you could use it for K to 12. New York still says they'll tax you on it. So before doing that in the state of New York, please, you know, discuss that distribution if you're doing it for K to 12 education from a 529 plan. Moving expenses are not deductible unless you're for military personnel. Personal casualty losses are not deductible unless you're in a federal disaster area. So, you know, if a tornado rips down your block and Biden calls it a disaster area, I mean, you're not in luck, but it's a disaster area. So if you have losses, you can take them. If he doesn't, you can't take the losses. I'm sure this is something that impacts everyone here. The estate tax exemption is increased to $12,060,000. So for everyone worth over that, it's time to sweat because it's $12,060,000 per person. So if you happen to be married, you're at up to over $24 million. And then New York's is $6,020,000 per person. So if you're married, it's over $12,040,000. So pretty big numbers on the estate tax. They keep going up. And, you know, the alimony issue, it was a big difference, you know, in 19 alimony, if it's grandfathered in prior to this, it's still deductible. But in 2019, it's no longer considered taxable income to the recipient and is no longer deductible to the payer. All the previous settlements were grandfathered. So, you know, just something to, you know, understand. reason why they did that is they didn't want individuals structuring their income to reduce their taxes, meaning one spouse was high earning, cuts their income in half, and then you have two lower earning individuals. So that was a change that was made, closing up a little bit of a loophole. Now, on the next slide, we're looking at tax tips. Contribute to a retirement plan. If you're paying fees for management, pay them from, pay them from the accounts they're coming from. Because if you don't pay directly from the IRA or the IRA account, and you pay via check, you can't deduct it if you're paying a management fee. Charitable contributions, if you're itemizing, okay? So, if you're itemizing, you may want to gift to your charity of choice every other year and just double the amount so you receive more of the tax deduction. Or you're able to itemize that one year and take the standard deduction the next. Interest rates are still low, so it doesn't hurt. Refinance your equity lines, refinance your debt if you can. I know potentially it's a write-off, but I'd rather lower interest than the write-off. I'd rather you pay less interest than taking the write-off. And then, file early. No reason to wait around. And also, there's been fraud. People are filing returns. So it's good to just get your tax return filed sooner than later, and get it out of the way. Right now, I don't know if there's going to be extensions again on the tax returns like there were for the past 2 years. Now, on the next slide, just some tax tips. You want to at the end of each year, look at tax loss selling. You want to coordinate your charitable giving, your mortgage payments, your medical expenses to ensure you're maximizing your itemized deductions. I know dental and orthodontal are huge expenses, and very rarely are they 100% covered by our employment or health coverage. So, I had someone, I said, look, put all those dental, pay all the orthodontist bills in one calendar year. And maybe we could get over the 7.5% of adjusted gross income because you got 3 kids with braces. You could donate your required minimum distribution. One way of avoiding taking it into your income, if you're over 72 years of age and you have to take a distribution and you do contribute to charities, one of the issues would be, or one of the strategies would be, is here, I have to take $6,000 from this account, but I normally donate $6,000 to this religious organization. Take my $6,000 and just send it directly to that organization. I don't have to pay taxes on it. I don't have to, it's a complete write-off. I don't take it in, and I cover my RMD and I fulfill my charitable. And New York State 529 contributions, these have to be funded by December 31st. But if you're single, it's 5,000, and if you're married filing jointly, it's 10,000 that you could take annually for contributions made, and it's a deduction off your New York State income tax. Okay, so essentially, it's the equivalent of them rounding. If you put $5,000 away, you should get an extra $350 back at the end of the year in your New York taxes. Or if you put $10,000 away, you should get back around $700. Okay, and that number could be even higher if you're in the city. So on the next slide, this is the overview of the Doctors Council benefit, tax preparation services and financial planning. We provide the reduced cost tax preparation services. We also provide a greatly reduced cost financial planning program, where the information there is listed. And if you are interested, you could contact Doctors Council, and or ourselves, Stacy Braun, and we could, provide information to you. And, on the last slide, Stacy Braun Associates, is our contact information. Our web address is stacybraun.com, and our phone number is the 888-949-1925. So that concludes the presentation. I know there were a lot of questions asked during the presentation, and I'd be more than happy. And I know there were a lot of questions that came in prior, which, once again, would be happy to go through and answer, Kevin, if we have the time.
Sure. First of all, Paul, thank you very much for that presentation. If you need to grab your breath or get a glass of water, but thank you very much. There you go. And we're going to start off with the questions that were submitted in advance, then we're going to go to the questions in the chat.
Sure.
So Paul, for a two-income physician family, when is it better to file a joint tax return and when is it better to file individually?
Okay. The answer to that question is the tax software that's being used normally, and this is a question to ask your tax preparer, is if it runs a comparison, a married filing separately versus married filing jointly comparison. Okay. And of course, you would take the lower of the two tax liabilities. There's a very, very strong probability that married filing jointly will have a lower tax liability. The times in which you wouldn't do that would be if you're looking for potentially student loan, that you're on an income-based student loan debt forgiveness program. I see a lot of people filing separately, so their incomes are lower, so they qualify for lower income-based repayments. Or if you're concerned about your spouse's, let's say there's legal concerns or ethical concerns on how the spouse is filing or why they're filing how they are, I would strongly recommend filing separately.
Okay. I work at New York City Health and Hospitals and also have a private practice separately at a different location. I'm just trying to get an understanding of how to address taxes for both.
Well, what you would look at, what you would be looking at there is you have your tax withholdings, and you would try and estimate what your total tax liability would be for the year based upon your income or your previous year's tax return. And you could always adjust your withholdings at each employer or make additional contributions. So it's a common area where when you have multiple employers, you're under withholding because employer A doesn't know what employer B is paying you. But like I said, you need to kind of do an estimate of what your total tax liability would be for the year and then adjust your W-4 or your withholdings at each employer.
Got you. Then there's a question that states, I have a specific question about how to set up for private clinic and available tax deduction for a new homeowner.
Well, in setting up a private clinic, my recommendation would be make sure you keep a copy of all your records, startup costs, and then, you know, I'm not exactly sure what other areas, but you might need to consult an attorney, you know, on some of those, how you're formulating your corporation, et cetera. As far as a home goes, you know, your deductible expenses are your mortgage interest, your property taxes. So those would be the big areas that you would be looking at, and then taking and looking to see where you stand as far as the standard deduction goes or whether you'd be itemizing.
Great, thank you. What should I do on my tax filing if my wife contributed to a Roth when single and later in the year we married and filing together and no longer qualify for the Roth due to income limits?
You'd have to you would have to withdraw the funds from the Roth. Yeah, and because you don't qualify at that point, so the funds would need to be withdrawn.
And when question is, when companies give stock bonuses that vest over multiple years, how do I file this? Is it the year the bonus is awarded, the year the bonus vests, or when I sell the stock itself? For example, I get $10,000 worth of stock in my brokerage account from my employer and it fully vests in 4 years. I sell the stock in 4 years after it fully vests, but the stock dropped in value and only sold for $5,000. How do I file this?
It's difficult to say without all the specifics of it, but two different types of income. You have ordinary income that would be due upon you being granted or bonused the stock. I don't know how this was received. And then from that point in time, you know, anything would be a capital gain or loss after you've paid the taxes on the purchase. So, you know, if you purchased it or paid taxes on $10,000, that would be your cost basis. And if the stock dropped to $5,000, you would have a $5,000 long capital loss.
Thank you. Can you discuss what happens with the 403B and 457 accounts, both pre-tax and post-tax Roth when you retire? What are the options?
You know, most employers will allow you to leave the money at the current custodian, and the custodian is who holds the funds. Or you have the ability to do a rollover and roll the money out to the custodian of your choice. A lot of people choose to do that because they think there's, potentially lower fees if they're using like a Vanguard or a Fidelity, and there's potentially more investment options at an IRA or a Roth IRA. So you could leave it if you're happy there, or you could roll it out to an IRA or a Roth IRA, which would be no tax implications and be treated separately, but treated the same, just giving you the ability to, maybe consolidate numerous accounts and or have more investment selection.
Gotcha. Next question. I'm 67 and I'm interested in strategies to decrease my future taxes on the IRAs I've obtained over 34 years. I have started a backdoor Roth already.
You could do it depends on where the money's being held, depending on what your future tax brackets or liabilities you think may be, Roth conversions potentially, but at this point in time, maximizing, I don't know if they're employed, not employed, but if you're employed, you would be able to max out retirement accounts, look at the backdoor Roth conversions, but don't know where the future tax liability would be.
If a person is contributing to a 401k after the age of 70, are you required to take a minimum required distribution?
Very good question. The age for RMDs now is age 72. Okay, so 70 to April 1st after the year 70 and a half that we've been drilled into our minds is now age 72. And the only way out of a required minimum distribution is if you're 72 years of age, employed at the end of the calendar year, and the money is with your current employer, okay? So if you have your retirement accounts with your current employer, okay, then, and you are employed at the end of the calendar year, an RMD does not need to be taken. But if you have an outstanding IRA of $100,000, which is an individual retirement account, not part of your employment, okay, or not in your employer plan, then the RMD must come from that account or those accounts.
Gotcha. Can you comment on any commonly missed out tax deductions? And can you comment on any tax deductions related to working from home?
They took away all the miscellaneous itemized tax deductions. So really the tax code's been slimmed down. There's not much I see out there that's missed. Working from home and home office deductions, if you're employed at a W-2 employer, is one of those miscellaneous itemized deductions that was taken from us. So unless you're a private practice or self-employed, the home office has no value to you, regardless. Unless you're, if you're a W-2 employee working from home, there is no write-off.
So those are the questions people submitted in advance. Thank you, doctors, for doing that. Now, transitioning into questions that have come up during the meeting. Question: is it a medical cost if cash is spent on weekly physical therapy?
Yes.
That's definitive. If you are both a W-2 employee and have a PC, can you use any of these itemized deductions?
You could use them against your private practice.
What do you mean by, and I presume, Paul, when you say using.
Sorry, could you repeat that? Could you explain that a little bit more?
Well, any expenses that you have, okay, would have to be held against and accrued by the private practice. So it's a touchy area, because if you have a medical license you're paying for, if you're using that medical license for your private practice and it's part of your W-2 employment, we'd have to gauge how much of it could be written off.
Gotcha. And I would surmise,
Oh,
Paul,
it would be like a percentage.
Potentially, I would have to see the situation on it.
Thank
Like
you.
your malpractice insurance might be all against, because your employer covers your malpractice while you're a W-2. But if you have malpractice insurance for your private, it would be 100%.
so Paul may be to some degree very fact specific, and I would also surmise that it might, what comes out of the W-2 employment relationship and what comes out of the PC aspect, right? Not
Correct.
cross mingling them. Okay, got you.
Correct.
What do you mean by phase out in child tax credits? What is
So-
phase out?
phase out means that you get the full credit, and these are pretty exact. You get the full credit if you're under 400,000 married filing jointly AGI, but it's not a cliff. You don't get nothing if you're $400,001. It phases out from 400,000 to 438,000. So if you come in with 420,000, you might only get 30% of the benefit or the
Gotcha.
credit.
Can a person declare work from home deductions?
If you're a W-2 employee.
Is single same as head of household if you are single?
No, they're different standard deductions for head of household and single. And it's on that presentation as well. I didn't go into it. I just went through the major single married filing jointly. But if you have a dependent at home, you could file head of household and your standard deduction would be higher.
Is private school tuition deductible?
No.
What is an S corp?
It's a type of corporation. It's a pass-through corporation, meaning that the corporation's income would pass through to your personal income return.
What are the requirements to meet the 20% deduction for pass-throughs?
I think there's some. I would have to get into detail on that. I would have to follow up with that.
All right, so if that doctor has that question, if you can email it to me, I will endeavor
Yeah,
to
absolutely.
get it to Paul. All right, thank you. Are there income limitations on Roth IRAs?
Yes, and that was in the presentation. I think it's in the presentation. It's 208,000 if you're married filing jointly, and 108 or 106 if you're
140.
140
if you're single.
in 2021, if single, and married filing jointly is 208 in 2021.
And that's gross income, not adjusted.
That's adjusted.
That's adjusted.
Thank you. Is Roth income limit the gross income or the AGI? We just answered that. Okay. What about Roth 401k?
They're subject to the standard 403b, 457, 401k limits. It's a great loophole, meaning that you're not no income limitations on a Roth 401k, 457, etc.
Got you. In 2021, wife contributed to Roth directly before marriage, then got married, and income now over limit. Can she
We
take
answered
money?
that.
We did that.
Yeah, that one was, I think that might have been a similar question, but the money would have to come out because you no longer qualify.
Got you. Thank you. Can you talk more
So-
about,
Sorry, there's a follow-up to that question. After she takes out the money from the Roth, can she still do backdoor Roth the same year or no?
Yes, I think so. I would have to, it's a timing issue on that. I don't know if she could convert it the following year. I'd have to get back to you on that.
Doctor, if you email me, I'll hook you up with Paul.
I don't know when you realized that it couldn't be done and when the money was withdrawn.
Okay, thanks.
Was it in the same calendar year or was it the following year? So I could get back to you with an answer on that. I wouldn't.
So yeah, doctor, if you email me, I'll connect you with Paul. Can you talk more or flush out more about a backdoor IRA, what that is, what you mean by it?
It's a backdoor Roth IRA, and what that is you make a contribution to an IRA, and then ideally at the same time, same day without any gains or losses in it, you convert it to a Roth. So you're making an IRA contribution and then converting it to a Roth. Usually people do it within the same day, makes it easier.
Isn't that pre-tax going to post-tax?
Yeah, you're gonna pay taxes on it, on the
No,
conversion.
because contributing to an IRA with post-tax money, you mean?
Yeah, correct. And then you're converting it.
And what's the advantage?
The money grows tax-free.
Paul, that goes back to when you say, do you pay now or pay later, right?
Correct.
Because with the other regular IRA, so to speak, you pay the taxes down the road, whereas in the Roth, you pay it up front and then it grows tax-free.
Correct.
Right.
Is there income limit on that? On backdoor IRA?
Roth, no.
Okay.
There's a question, hello, about how much is the average tax return fee for this service to help Paul out? and Paul can correct me if I'm wrong, but the fees range between 200 and 600 for the tax preparations, depending on complexity. At least
Correct. Yeah, that's correct.
Yeah. Thank you. What is the minimum charitable contribution to be beneficial?
Yeah, I under that question. So really, most people make charitable contributions because they wish to gift to the institution or charity. But if you're trying to maximize it, there's no answer to that question because we'd have to know what your itemized deductions were compared to your standard deduction. So if your itemized deductions are $8,000 and you make a $4,000 charitable, you're still taking the standard deduction of $12,550. So there would be no value to that charitable contribution. So it really depends. There's no way of answering that. You would have to look at your itemized deductions to see if your itemized deductions compare it to your standard deduction, and then to see if the charitable will help you.
Can you repeat what is the itemized deduction number? Thank you.
There's 4 of them. Married, single, I think it's 12,550. I think the married's 28,000. I don't, off the top of my head.
Is that in the PowerPoint?
Yeah, it's in the PowerPoint.
And doctors will be emailing out the PowerPoint to those who RSVP'd, so you can get that.
Yeah, and it's different from married separately, married jointly, head of household, and single. So there's 4 different numbers, and they go up each year. So off the top of my head.
Gotcha, but we'll send it out to the doctors. Is 529B, as in boy, tax deductible in New Jersey? Is there a 529 plan equivalent in New Jersey?
Yeah, no, not really. 520, the 529 plan in New Jersey is through Franklin Templeton. I like New York's plan. I live in New Jersey, actually, and I use the New York plan. So there is no tax deduction in New Jersey for 529 plans.
Got you. Comment, really good presentation. Thank you. Can we get PowerPoint? Yes, thank you so much. Is 529 contribution dollar per dollar deduction?
There's no deduction on a contribution to a 529. New York State does have a New York State tax write-off, 5,000 single up to 10,000 married filing jointly. But there is no federal. The benefit to the 529 is the money grows tax deferred and is withdrawn tax free, just like a Roth, if it's used for qualified higher education. And the new stipulation is you could use it for K-12 private schools, but New York is going to hit you on that. So we have to discuss that if you're going down that road.
Gotcha. Can we get a copy of the slides? Yes, we'll be emailing out to those who are RSVP'd. Can you give a range of the tax prep fees depending on complexity between 200 and 600? Also, I refer you to the flyer we attached with the emails going out about this. If you want more information, please email us or call us. We'd gladly get that to you. What is a backdoor Roth conversion?
We went through that, but that is when you make a contribution and then convert it over.
Can I deduct elder care costs? I'm paying $50,000 from my HHAs for my mom. Can she or I deduct the cost of home health aides?
It would have to be considered a medical expense. And I don't know who's paying it and who's medical. I'm assuming it's the mother's medical expense, but I'm not sure who's paying it. Yeah, we need more information.
The doctor's saying I'm paying for it. So if the doctor is paying for his or her mom.
I don't know if the mother's a dependent or not.
All right, got you. If married to a J1 visa with lower taxes than US citizen and file married jointly, how does that work? Or do I have to file married but separate?
I couldn't answer that question with any accuracy due to the fact it's the visa issue.
All right, if that doctor gets.
Yeah, it's something I could look into. Yeah,
Yes.
I mean, it's a very, well, it's a specific issue.
Next question. There is an obscure IRS rule that a person in 403B or 401K cannot take IRS deduction if income is $189,000. Is there any change to that now?
Not take an IRS deduction? I'm not, vaguely sounds familiar to me, but I'm not exactly sure. Once again, I would need to dig deeper into that.
Do I have to pay 100% of the cost from my parents if I want to claim them, my parents as a dependent?
It depends on whether how much of their own support they provide. If someone provides 50% of their support, then you can't claim them.
Gotcha. Until what age can you contribute to a Roth IRA?
As long as you got earned income.
There are some insurance products that rolls out from RMDs and is not tax deductible. Is such an arrangement available?
There's certain products that roll out.
I'll repeat it again. There are some insurance products that rolls out from RMDs and is not taxable. Is such an arrangement available?
Insurance products are tax deferred vehicles. Annuity contracts are not subject to RMDs, but they will be taxable upon withdrawal. Non-qualified annuities are not subject to RMDs.
Thank you. Your presentation was excellent. Thank you. This presentation was greatly appreciated. At what income does AMT set in?
There really is no AMT anymore. We don't see it, so not an issue for anyone in normal course of life.
What is the rule for charitable contribution if you take standard deduction?
Right now, very good question. It was in the presentation, so the numbers are there. It's $300. If you're taking a standard deduction, you could still deduct $300 if you're single, and this year $600 if you're married filing jointly. That's important if you're taking a standard deduction to understand that.
Thank you for the presentation. Next question, the $200, $600 that was stated, does that cover federal and state?
But
For the tax?
it would reduce your federal income.
No, I think the person's asking when we say the fees range from $200 to $600 for the tax preparation service, depending on complexity, that includes federal and state tax return.
Oh, yes, of course. I'm sorry.
Thank you, Paul. What is the penalty for using 529 savings for non-educational expenses?
Yeah, 10% penalty on the interest earned plus ordinary income tax on the growth. So whatever you put in is yours to take out. 10% on the growth and ordinary income tax on the growth. 10% penalty.
Thank you for an enlightening presentation. I live in New Jersey and bought a 529 for my granddaughter from Nevada 529 Vanguard. I pay New York taxes. Is this deductible on my New York state taxes?
No, because it's the Arizona plan, I think you mentioned. You're better off opening up the New York state plan. If you live in New Jersey, work in New York, you may be paying New York state income taxes. So I would open up the New York State 529 plan at nysaves.org. It's still through Vanguard, but there may be a tax benefit to you there.
Thank you for the great presentation. Paul, believe it or not, we've reached the bottom of the questions. I don't know now if I should say, Paul, for 400 points, please answer the following question. Or, if a train leaves Baltimore at 75 miles an hour and one leaves Philadelphia at 60, when will they connect? But we know some of the questions with taxes can be very, very fact specific and involve multiple aspects. We thank you, Paul, very much for your time.
Thank you for having me.
Doctors, thank you for taking the time to come in on this presentation. I don't know if Dr. Proscia, is there any closing comments you'd like to impart to us?
All I want to say is thank you very much, Paul, and thank you, doctors, for attending. If you have any questions, you know how to get the answers to that. Thank you again.
Thank you. This was excellent.
Thank you, everyone. Have a good evening.
Thank you
Well,
very
again,
much.
thank you very much, doctors. Good to see you. The best to you and your families. Keep safe and keep well. Thank you, doctors.